Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. We're coming to you live from the SALT conference in New York City. Joining us for this segment, we have Jack Abraham, founder and managing partner of Atomic, to discuss why now is the best time to build new companies. Jack, it's great to have you with us. Welcome to TradeTalks.
Great to be here. Thanks for having me.
And you just launched your fourth fund, $320 million on Monday. Tell us about that.
Yeah, well, as you mentioned, this is actually one of the best times in history to build a company. There are more opportunities, more building blocks than ever before. Every industry is virtually open to disruption at this point from some form of technology. Obviously there's been some disruption in the later stage markets, but in the early stage, when it comes to starting things, there's more talent than ever existed before, and we're going to take advantage of that and form some really interesting companies across a lot of different industries, and had a lot of investors that were very excited to join us in that.
And you recently just hired a new general partner, the former CFO of Postmates. What does that mean for Atomic and for the portfolio?
Yeah, Kristen Schaefer is someone we're incredibly excited to have join our team. She's someone I've known for more than a decade. She really helped navigate Postmates through, some tricky situations in their history. They definitely had some ups and downs. Ultimately, they exited to Uber for about a $5 billion valuation at the time the deal was actually completed, and she played a significant role in that. So she's working with us across our portfolio, some of the later stage companies that are approaching those similar moments that Postmates had of either having a liquidity event or plotting a path to go public, but she's also very plugged into the early stages and helping set our companies up for success.
So what is the studio fund model that Atomic employs, and how is it different? Because you really were the first to use it.
Correct, yeah. We started the first studio fund model in 2012. I started with my own capital actually after selling my first company to eBay. And the studio fund model is different in that all of the companies that we invest in, we create. So that's very unique. Normally in venture capital, you get pitched companies by a number of founders, you decide which ones you like and you don't like, and you invest in a few. With us, it's actually thesis driven, where we'll look at industries, we do a lot of research, we come up with a lot of ideas. We have a list of 800 to 900 ideas at this point for companies to start. And we've developed a methodology and a process to test the market risk behind each of the ideas. So in other words, one of the things that's been happening over time in venture and in technology risk has actually been coming down. There's so much open source out there, there's APIs, there's AWS, there's a lot to build on. What's really paramount is market risk. So if you can test the market risk behind ideas and you can really understand whether these ideas are going to work or not, and have confidence that by building them and investing the capital, it's worth the opportunity costs of the time and the capital, it's a really good strategy. That's something that we launched and invented in a fund model. There are now hundreds of studio funds that try to employ different strategies, but we're now the largest in terms of AUM in the technology category, and I've gotten pretty good about validating and invalidating ideas and starting and scaling companies.
It's so relevant in this environment too, of course, that we've seen with the valuation reset, being able to have that predictive model and not just go for the sexy story or what valuations looked like, and all these unicorns and so forth, so you're able to see ahead, right? Why is now, particularly with the market downturn, why is now the best time to start building these companies?
There are a few things that happen in downturns that make it particularly a great time to start a company if you have the capital to do it. But that's a big if, of course. We have the capital now, we have a lot of dry powder to be able to deploy. The biggest reason is there's more talent availability than ever before. So if you think about companies, they go and they raise capital. What's the purpose of the capital for a technology company? It's to hire amazing people. And there are more amazing people available than ever before. That's both because some of the larger companies have been downsizing, but it's actually because largely toward the end of the last cycle, a lot of people went to the growth stage. They were thinking, I'm going to join a company and in a year or two it's going to go public, I'm going to have a payday. And of course the markets have turned and some of their options are underwater. Some of those companies that did go public aren't doing as well. So they want to boomerang back to the early stage. Just like capital is flowing to the early stage, talent wants to be there, they want to build today, and they want to ultimately exit into a different market. So we just have floodgates of talent coming to Atomic, thousands of people that are applying that want to start companies with us. A volume we've never seen at any point in our history that's so large it's to the point we actually have trouble processing it. So that's the number one thing. The second thing is you get a lot less competition in downturns. What ends up happening in hot times, any good idea gets replicated and there's another venture capital firm that funds number 2, number 3, number 4, And that actually makes it really difficult to operate and build a business. So you have a longer lead time to be able to go and build something that's really special. And then the third thing is companies actually learn the right habits during downturns. Actually, about half of the Fortune 500 companies were started during a downturn. Those are limited periods in history, half of all the Fortune 500 companies. A lot of that is they learned good habits. They built a good business. They weren't, so to speak, selling dollars for 50 cents, which, venture
Right.
capitalists criticize some companies for. They have to, and they're absolutely forced to build a real company that's capital efficient and scalable.
So, in my mind, this valuation reset needed to happen, right? I mean, there were companies that were getting silly valuations with not profitability, they didn't have the governance on the board, the cash didn't make sense on the balance sheet. And then of course, it's the public investor that gets stuck at the end of the day. And so not only from that perspective, but teaching young management teams how to appropriately manage the budget sheet, their board, their management teams and so forth, to build well-structured companies. It feels as if that's the silver lining to it.
Yeah, it's interesting. I'd say if you asked some colleagues I have in the venture capital industry, they'd say, look, the goalpost shifted. The
Right.
public markets were rewarding growth at all costs. Everything was valued on a revenue multiple in the last cycle. So that's what they were trying to deliver. They were trying to deliver companies with a lot of revenue and a lot of growth, and the bottom line didn't matter as much. As interest rates go up and you're discounting those cash flows back to the present, actually when you reach profitability matters a lot more, and it's totally changed the game in terms of how companies are valued and what the exit multiples are ultimately going to be. So venture capitalists have shifted with that, and my perspective is if you always build a company that is sound and can grow without burning a lot of money, you're going to do well in a good environment, you're going to do well in a bad environment, and that's what you should be gunning for. And there are just good habits that you can set up early on, like measuring unit economics, literally at the seed round, you can do that, or at the Series A, focusing on optimizing them. I think the best companies, there's a phrase, nail it before you scale it. And a lot of companies were not nailing it before they scaled it. They built something and then they just scaled it really quickly. The problem with scaling it really quickly is your problems compound very, very quickly and they become harder to fix at scale. So if you can really focus on fine-tuning what you're working on early on and really nail it, you can then scale it and you'll have a great business guaranteed no matter what the market is doing.
Right, I mean, to your point earlier, it's math. You can't fight that.
Correct.
No matter how great your story is or what your revenue looks like, it's math, especially
Correct.
with the interest rate environment that we've seen. Give us an example of a company that was built inside Atomic Studio Fund model.
One company that we started at Atomic is a company called Hims & Hers, which we took public a couple of years ago. Actually from launch, it was 3 years to taking that company public. Telemedicine company. The thesis that we had was telemedicine 1.0 is really about a virtual doctor visit. Mm-hmm. So what's the pain you're solving for the consumer? Well, it is kind of a pain to go and call the doctor and sit in a waiting room and schedule it a week or two out. So if you could do that instantly, you're solving a little bit of a pain. But we said, what if instead you focus on conditions that people are suffering from that are chronic, and you use telemedicine instead as a vehicle for diagnosis, and you change the business model to monetize on treating that condition for the long term. So we sort of invented that model actually as well out of Atomic. We were one of the first people to do that. And we tested that. We tested a ton of different conditions with the thesis of what's going to be the burning condition that's going to activate people. We tested 10 or 12 of them. We found hair loss was far and away the burning issue. It's very interesting. There are 2 drugs that work extremely well for hair loss. 50 million people suffer from it. At the time, only 50,000 people were being treated for it. That's 0.1%. It makes no sense. So by telling people these solutions exist, you can actually do them online. It's only going to take 5 minutes. You don't have to go to the doctor's office. And you can try it at home and see if it works. And if it doesn't work, you don't have to use it anymore. Totally revolutionized the model, expanded the market massively. Now we're in 20 to 25 different categories of conditions and drugs that we're treating across men and women. So that's an example of how to validate a company and really nail it before you scale it. And once we'd nailed it, we scaled the company really quickly and took it public shortly thereafter.
So what areas are you excited about now to build in?
Well, certainly healthcare remains interesting. There's a lot that's broken in healthcare. There's a lot of opportunity to fix things there. 33 cents of every dollar in the US economy goes through that system, and it's broken. Unfortunately, outcomes are not getting better in a lot of categories. People are dying sooner. Lives are not lengthening in the US, and the costs keep going up. So there's a lot to do there. You could work there your entire life and build really nice companies to fix it. AI clearly is a really big thing. A lot of buzz right now is AI and consumer. Think of like ChatGPT and things you can go and access on your computer. I think that AI is going to make its way into every facet of the enterprise. So think about any job to be done in a company. That could be a function, that could be a specific task, that could be a workflow, that could be something specific to a vertical or an industry. All of those things are going to be made a lot easier, faster, and cheaper with AI. So if you can figure out how to apply this technology in really interesting ways to make people more efficient, make companies more productive, that's going to be a really big deal. But as I mentioned, in addition to healthcare, real estate continues to be a good industry to innovate in. Finance continues to be a good industry. Commerce continues to be a really great industry. Increasingly, actually, energy and climate are really great places to start companies.
Yeah, climate tech for sure.
Climate tech for sure. The government passed the Inflation Reduction Act, $360 billion of which was essentially allocated to climate-related initiatives to help us transition to a clean energy economy. And there are going to need to be a lot of companies that are created to help with that transition. And certainly the leaning in both of the government on that, but also private capital sources are now much more willing to fund those initiatives. There is going to be a lot that will be done there and will help advance those goals and get us to a clean economy.
Let's hope so. All
I
right,
hope so.
Appreciate the insight. Thanks for joining us on Trade Talks.
Excellent.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks so much.